Good evening, Canada. Welcome to week 2 of the Investor's Guide to Thriving Fall Series. Well, it may be October, but I have to say the past few days in Toronto have felt a bit more like summer than fall. And speaking of mixing it up, we've seen quite a bit of volatility in recent weeks as markets debate whether or not inflation is spinning out of control and whether that begets rising rates, effectively pulling back the proverbial economic punch bowl. Some days it seems to matter, and other days not so much. But what about earnings? Do they still matter? And if so, how much should we be paying for them? That's the subject of tonight's talk, featuring my good friend and business partner, Mr. Larry Berman. Some of you will know Larry from his weekly show at 11 a.m. Eastern Time on BNN, but people are often surprised to learn Larry doesn't actually work for BNN. Despite doing the show for what's going on 16 years now, and market call for 10 years prior to that. Nope, he does it because he's passionate about helping educate and empower Canadian investors. That and the exposure has been pretty good for business. What business is that, you might ask? Well, we started in 2006 with ETF Capital Management, our portfolio management firm, where we do two main things. Firstly, we partnered with BMO ETFs to manage the Sleep at Night ETF and funds of ETFs, which are available to you through your financial advisor or online brokerage. We also provide holistic family wealth planning and portfolio management directly. You're more than welcome to learn more by visiting etfcm.com, which was recently updated with lots of video content to explain our investment philosophy and process. If you like what you see, you can also request a custom and confidential portfolio proposal for investments starting at $1 million. And ETF Capital Management is the original and founding partner of Quintessence Wealth, which is our platform for advisors and portfolio managers. It provides a fintech-driven alternative to traditional independent brokerages. Q Wealth Partners is now up to 11 partner brands from coast to coast, managing in excess of $2.5 billion. Well, turning back to the Investor's Guide to Thriving series, we've been doing these events for free to the public since 2009 in support of two charitable organizations, which Larry and I believe are doing some very important work. The Sick Kids Foundation, we are supporting their research efforts to find better cures for childhood leukemia. And at the Baycrest Foundation, we're supporting their world-leading Alzheimer's and dementia research efforts. With your help, we've been able to raise over $450,000 for Baycrest, and we're ever so close to hitting $100,000 in support of sick kids. But there's still so much work to be done in these fields. So if you enjoy the programming in this series, we only ask that you join Larry and I in supporting sick kids and Baycrest. If you'd like us to match your donations, please use the links in the survey you'll receive after the event, or visit investorsguidetothriving.com and use the links there. This is how we're able to track and match your generosity. For those of you who have made donations, thank you very much. That survey is also your gateway to access the webinar replay. It'll arrive in your email tomorrow morning. Tell us how we did and you'll get access to all of the above and be able to submit questions for next week's webinar. Investor's Guide to Thriving is brought to you through a lot of hard work and support through our longtime partner, BMO ETFs. They've been our partners in ETF education since 2009. And tonight we're joined by Erica Toth, Director of BMO ETFs, to discuss why it can be smart to include some ETFs in your portfolio if you're looking for efficient exposure to broad indices. Erica, the virtual stage is all yours.
Thank you so much, Jared. I'm thrilled to be with everybody tonight. So tonight, my portion of the presentation, I'm going to take about 15 minutes here, and we're going to go back to basics. You might have already heard the expression that a portfolio is only as good as your core. So tonight, we're going to hone in on why large and liquid index ETFs shed some light on why they should be a core component of any portfolio. So moving on to the next page, S&P Dow Jones Indexes is of course one of the best known index providers in the world. Some of the educational materials we're going to be covering today is drawn from their research. They put together some excellent work, including their SPIVA report, which stands for S&P Index versus Active and measures the performance of active funds versus their respective indexes over different time periods, and also their indexology blog. So if you're interested in doing some further reading, you can access their fantastic resources at spglobal.com. So moving on to the next slide, just want to set the stage and talk about the differences between passive and active and why investors might want to use actually both of them in their portfolios. So passive, or the term that I prefer, would be the index tracking approach. Index eligibility, in order to be included into an index, a security has to follow a strict set of rules. Indexes are known for their rock bottom fees. So by nature, they tend to attract very fee-conscious investors, but also those who are looking for broad market exposure and those that tend to believe that markets are efficient, or in other words, reflect all of the available information and that it's very unlikely for any manager to be able to consistently outperform. Now, active management, on the other hand, is where you have securities that are selected by a portfolio manager. Typically, these are higher conviction approaches. The portfolio manager might use fundamental analysis, so looking at a company's profitability, cash flows, debt levels, for example, or the manager might also use technical analysis, so based on a security's trading patterns. Generally, investors that are attracted by active management tend to believe that markets are less efficient. So what is this chart up on the screen over here? I would say that indexing has gotten a bad rap at times. There's a misconception that passive or indexing does not tend to do well in weak markets. So I wanted to shed some light on that. Even in very strong markets, good managers still tend to underperform, in about 2/3 of the cases. So strong managers over the very long term can still outperform the markets in about 1/3 of the time, but in moderate markets and in bad markets, it's about 40%. In those cases. So that said, there are some very valid reasons to have some active management in your portfolio as well. For example, do you need a higher level of tax efficient income? Are you looking for lower volatility? Or do you want the potential to outperform the market with a strong manager? Perhaps you want to take a higher torque approach in a particular niche area of the market, for example. So moving on, so just I wanted to throw that chart out there just to break that misconception that indexing doesn't tend to work well in weak markets. It actually tends to hold its own, whether markets are weak, moderate, or doing quite well. So by the way, I want to make it clear that index and active are not mutually exclusive. You don't have to decide one versus the other. Investors can and do want to use a blend of both in most cases. Generally, that's what most people gravitate towards. It tends to be the best of both worlds that way. With active management, you have the benefits of automatic rebalancing, a professional portfolio manager doing that for you. You have the ability to be more dynamic and more tactical, either react or anticipate changing market conditions. And also with mutual funds on the active side, you have the potential to do pre-authorized contributions or systematic withdrawal plans. And there's also, certain things such as the corporate class structure, which can add to the tax efficiency of certain active strategies. Now, passive, on the other hand, famous for its benefits such as low cost, instant diversification. They're an excellent easy access tool for either sectors or particular asset class exposures, and they're extremely transparent. So moving on to the next slide, it's for those reasons, the low cost, the diversification at any account size really. So whether you have $500 to invest or $5 million, it gives you that same benefit of diversification, the ease of exposure, the transparency. It's for these reasons that ETFs have become increasingly popular as core building blocks for investors' portfolios, no matter the size. In addition to those benefits, ETFs also allow for currency choice. So the ability to go either hedged, unhedged, or in US dollars, even if it's a Canadian listed ETF. So for example, BMO is, by the way, the only provider in Canada to offer the S&P 500 in 3 currency versions, unhedged, hedged, and in US dollar units. So you can pinpoint the exact currency exposure that you need in your portfolio. Another key benefit in ETFs is that they're extremely liquid. They can be traded with ease at any time during the market hours. And I should also highlight that as the second largest ETF provider in Canada, BMO offers some of the largest and most liquid ETFs in the marketplace. And in more than a few categories, we actually are the largest. So for example, our S&P 500 ETF ZSP is actually the largest unhedged US equity ETF in Canada, with assets over the $9 billion mark. ZEA is the largest MSCI EFI ETF covering the developed markets ex-North America. And ZAG, our aggregate bond index, is the largest and lowest cost fixed income in Canada. I should also mention that, sorry, going back to that slide just for a sec, Larry. I should also mention that BMO's put together a public website that's chock full of educational and value-added materials on ETFs. The website is etfmarketinsights.com, which is newly redesigned, brand spanking new, and just went live today. So I wanted to mention that, etfmarketinsights.com. Check it out if you're interested in educational and value-added materials on ETFs. You can find a whole list of the largest and most liquid ETFs in Canada, the one that I have up on the screen here on the right-hand side. So this list includes BMO and other providers, and it's sorted by asset class. So you can find the largest and the most liquid ETFs in any asset class from any provider in Canada. And this is under resources and in the education center of etfmarketinsights.com. So moving on to the next slide, in the ETF space over the last several years, there's been a huge proliferation of product. So back when I started on the BMO ETFs team, I think there was 5 ETF providers in Canada at that point. And now there are over 40 ETF providers in Canada and over 1,200 listed ETFs on the Toronto Stock Exchange. So there's been a trend, with this proliferation of product that we've seen towards launching of lesser known indexes and custom indexing. However, true core ETFs are based on well-known indexes. For example, the S&P 500, the S&P TSX Cap Composite, the MSCI EFI, and the MSCI Emerging Markets, to give a few examples. So these are the industry standard. They're widely used as benchmarks, both by individual retail investors and also by institutional investors, and they're widely quoted in the financial media. And moving away from these known and widely followed indexes can also produce discrepancies in terms of risk and in terms of returns. So one of the great things about ETFs is how transparent they are. And this makes it a lot easier for you to do your homework before investing. So all of the major ETFs in Canada tend to post a full list of holdings on their website, mostly on a daily basis. So you know exactly what it is that you're owning. You can ensure this way that your portfolio is properly diversified, and it makes it a lot easier to compare between different providers and between products. So we're going to take a look now at 2 of the best known indexes. We're going to look at the S&P TSX Cap Composite and also the S&P 500. So the TSX is efficient exposure to the largest and most liquid stocks in Canada. With ZCN, which is our S&P TSX Cap Composite ETF, you have a well-diversified exposure spread across 237 stocks and spread across all of the different sectors of our economy. So that includes banks, insurance companies, pipelines, telecoms, grocery stores. And at 5 basis points, or 0.05% management fee, ZCN also happens to be one of the lowest cost ETFs out there, providing exposure to this index. So that's a lot of bang for your buck. Moving on to the next slide. I mentioned these SPIVA reports earlier, the Standard & Poor's Index versus Active. The S&P publishes these reports twice per year, so in June and in December of every year. Just Google S&P SPIVA report and you'll be able to get the most recent ones. And they measure the percentage of funds that are underperforming their respective benchmark indexes. So the slide I have up here shows what that figure is for each asset class. This is as of the latest June 2021 report. And in general, what you can see is that the longer the time frame, the greater the chance that more active managers will underperform. And to just give a few examples, for Canadian equity, 2020, last year, 60% of managers underperformed, but looking at 10%, at the 10-year figure, it's 83%. There's a common refrain that in the small cap space, it pays off to have an active manager. And in 2020, for Canadian equities, that absolutely rang true. Only 15% of active managers underperformed their benchmark last year in Canada for small cap. As you can see, on a relative basis, when you compare it to the other asset classes over here, active management was more likely to add value in the Canadian small cap space over the last 10 years. Going through all the asset classes, Canadian dividend-focused equity, very tough to outperform the benchmark. The US S&P 500, a notoriously difficult benchmark to beat over the long term. When you go onto the international equity side, a little bit less difficult to beat, but you do still have a large percentage lagging that index over 10 years. So it goes down from 96% on the US side to 85% over 10 years on the international equity side. So I think what this slide does is it paints a really clear picture of why investors should have at least a portion of their portfolio, their long-term core, that is dedicated to having some broad index exposure via ETFs. You never know what year's active management is going to do better, and you never know what year's passive management is going to fare better. So a solid bet is to own a little bit of both. And looking at the longer term numbers, areas where a manager is more likely to be able to add value, you're looking at, like I said, Canadian equity, small cap, Canadian equities in general, and also international equities. So just a couple things to keep in mind there. So let's now turn our attention to the S&P 500. This is probably the most famous index in the world. It's a diversified basket of the largest and the most liquid 500 American stocks. However, these companies are multinational, so their revenue tends to come from across the world. You have access with one ticket to all sectors of the US economy, so in one trade. Tech over the last few years, of course, being the dominant one, followed by healthcare, consumer discretionary, financials, communications. And ZSP, as I mentioned, is the largest and most liquid S&P 500 ETF in Canada with a rock bottom management fee of 0.08%. That ETF has upwards of $9 billion of AUM, and BMO is the only provider to offer all three currency choices. So unhedged, which provides you the return of those US stocks plus the return of the US dollar. The ZUE, which is hedged back to Canadian dollars, it provides you just the return of the underlying stocks and strips out the currency returns, and also in US dollar units. So if you have US dollars to invest, especially in a non-registered account, I would always suggest to look at what .U units, so for example, ZSP.U trading on the TSX, what .U units exist on Toronto, because they're not subject to US estate taxes, and there are no T1135 foreign income verification taxes, foreign income verification forms, to fill out come tax time. So for a Canadian investor, if you have US dollars to invest, especially non-registered, always better to look for .Us that trade on Toronto rather than going and buying something that trades on New York. So I digress, moving on. Here are those same SPIVA numbers, drilling into a little bit more detail here. I'll summarize what I have up on the screen. We're not going to go over everything line for line, but what you can see here is the US equity universe, so divided into the S&P 500, which is of course the large cap index, the S&P 400, which is the mid cap index, and the US small cap index, which is the S&P 600. So you can see those same index versus active results, and goes all the way, even longer actually, this slide, so back to 20 years. So looking at the very long-term data, areas where a manager was more likely to add value was actually in the mid-cap space. So the S&P 400, a little bit more likely for a manager to be able to outperform there. S&P 500, the value portion of that index as well. So those are a couple of examples. And areas where a manager was less likely to be able to add value, more difficult to outperform, would be the S&P 500, so large cap index, and the S&P 500, the growth portion of that index. I should mention also, over shorter periods of time, like the 1 year, for example, you're more likely to see active managers be able to outperform, but the longer back you go in time, the longer the time period, the 10 year, the 20 year, it gets more difficult for a manager to be able to consistently outperform. So moving on, Quick recap here for each major asset class. Here's the likelihood of underperforming the broad index using a manager. So this is a pretty strong case for including some S&P TSX and some S&P 500 index allocations in your portfolio. I did mention, there's definitely a place for active management as well, and we definitely do believe in that. I highlighted a few reasons before why investors might want to use some active management alongside with their passive index exposure. But there is definitely, more than enough compelling reasons to have some of these index ETFs as part of your core. So last couple slides here. This is a quick reminder why diversification is across different asset classes is so important, because you never know which area of the market is going to do best in any given year. So over the last 10 years, US equities have done extremely well. But in the 10 years prior, between 2000 to 2010, this is sometimes referred to as the lost decade for US equities. So far this year, 2021, Canadian dividend paying equities are shining. So one easy way to make sure that you have a well-balanced, well-diversified portfolio that provides low-cost index exposure is an asset allocation ETF. Moving on to the next slide here, these one-ticket ETFs are one of the biggest innovations in the ETF world over the last 10 years. So they take care of automatic rebalancing for you, automatic diversification, but still provide access to those robust and well-known indexes at a very, very low cost. So all three major providers in Canada offer them. BMO's tickers, of course, start with a Z. So you have ZCon, which is our conservative asset allocation ETF with a breakdown of 60% fixed income and 40% equities. You have the ZBAL, which is 60% equity and 40% fixed income. You have ZGROW, which is 80% equity and 20% fixed income. And actually, BMO's coming in at the lowest cost. So 0.2% is the management fee, and that's for a basket of indexes. So you don't have to pay the fees again on those underlying indexes in the basket. What you see is what you get. So it's 0.2% the management fee. We also offer ZESG. That happens to have been the first balanced ESG ETF in Canada. Also has an allocation of 60% equities, 40% fixed income, but it's focused on the MSCI ESG leaders indexes. I should also mention ZMI. This is the BMO monthly income ETF. That was probably one of the first one-ticket solutions ever to have been launched in the Canadian ETF marketplace. This was actually launched back in 2011, so it has quite a long track record. And we're really pleased to share that we've recently chopped the fee on ZMI from 0.55% to 0.2% because we wanted to align it with the fees of our other one-ticket asset allocation ETFs. So this holds a mix of dividend-oriented equity ETFs and corporate bond ETFs for investors that are looking for just a little bit more income but want that same simplicity. So these ETFs help you reduce your transaction costs overall. You don't have to constantly monitor your portfolio and rebalance, and they'll help you keep your asset allocation in check over time with your stated risk tolerance. So you can see that simplicity can really be a beautiful thing. So that wraps it up for me tonight. Before I pass it on to Larry, let's go to the next slide over here. I want to just do a quick plug for our weekly educational webinars. The Market Insights webinar, we host these every Friday from 1 to 1:30 p.m. Eastern Time, and they drill down on a different topic every week, a deep dive, and it airs every Friday afternoon for half an hour. But you can also access the replays on etfmarketinsights.com. So thank you so much for joining me, and I hope you enjoy the rest of the show. I will pass it back over to Larry. Thank you so much.
Thanks very much, Erica. You know, Core and Explore is really a philosophy that I share. We run a lot of our portfolios that way, where you're going to get that core exposure to the main indexes in the world, and you're going to track the performance of the global economies, and then you diverge out and you look for thematic areas where you want to overemphasize in portfolios, and whether that's a sector, a part of the world, a type of currency exposure, or some of these great new thematic ETFs. So I agree completely. A core and explore type philosophy is something that would probably suit most of our audience these days. Any day for that matter. So into the presentation tonight. My original plan tonight was to do a back and forth with Monique Madden from U Potential, and I moved it to next week because I wanted to kick off and the understanding and the importance of how you approach building portfolios, not only just core, but the core part of investing being the plan, your goal. Why do you invest? And we're going to do that next week. And we moved that along because I thought it was actually more important this week to kick off, given earnings season, with a focus on earnings and a little bit on my approach and some of the ProEyes tools that I use to look at earnings. I've got a couple links and some interesting things here for those of you who want to dig deeper into earnings and what that means for markets and how that drives them. And then ultimately, what should we pay for earnings? How do we trade them, and should we? So I'm going to cover all those things, and of course leave lots of time for Q&A. There are a couple major index providers and aggregators of information. Bloomberg, which is a professional service that I use, BNN Bloomberg. So the engine behind that in terms of the professional capabilities, just about every portfolio manager or trader on the planet has a Bloomberg terminal in front of them. So it is core. And with all the analysts all over the world, what all these guys do, including FactSet, including the next chart, which is S&P Global, is they aggregate everything up. They say, what are all the analysts saying about the individual companies? What are the companies saying? Are they upping their earnings guidance? Are they reducing it? So there's 5 kind of factors. And if you clicked on that link there, you could actually go to FactSet. This is free. Everyone can go do this. And once a week, you can just kind of get an update and a dialogue from FactSet on what's going on with earnings. And you can basically keep track that way. So you've got, how are earnings growing? Are earnings being revised generally upward or downward? What are the guidances from companies? What are the valuations? So I'm going to focus a lot on that tonight. And then as results are coming out, how have they done relative to expectations? So those are, and that's the scorecard. So those are the kind of the elements of the earnings period. When you look at the aggregate, so Standard & Poor's gives you an Excel spreadsheet, and they update it. S&P Global, not Standard & Poor's, but it is part of that company. They will show you what the quarterly numbers are, what the expectations are for the next year, and so forth. So you can see on a quarter-by-quarter basis, we're getting reporting now for the third quarter of 2021 that just ended. And in January, we'll start getting reporting for the fourth quarter and so on. The current index level, what they expect those earnings per share to be, again, adjusted for how the indexing works. And then you've got your aggregate number. So for 2022 estimate, so we're now starting to think about next year's number. Depending on what service you look at, whether it's Bloomberg or FactSet or S&P Global, 215 to 220 is the range. When I talk about it in my work, I use the Bloomberg estimates because that's what's right in front of me all the time, every day. But I check it to make sure that it's not too far different than what all the other index aggregating providers are. Again, free, there's a link there. You can get the updates, you can download the spreadsheets, have fun with it. If you want to get into certain sectors and what the trends are, you can go as deep or shallow as you want in this area. But earnings matter. Markets get priced on earnings. And so the next graphic here is the narrative. So what I've got here in the middle chart on the bottom is the best estimate of earnings per share for the current year. So for 2021, based on Bloomberg, again, they take all the analyst expectations, they take the actual. So the first 6 months of the year, those are actual numbers. And then the estimates for Q3 and Q4, roll them up together, and that number is your $203.47. And so based on that, what is the multiple of the market? Where is it trading at today relative to that expectation? So current earnings versus forward earnings, and forward earnings, you're typically looking at 12 months forward, or when you start to get into the fourth quarter, it's, end of the next year, calendar year. And so there's two ways to look at it: rolling 12-month forward and end of calendar year. You're going to see different numbers. But I want to talk a little bit about the narrative, because the experts, the people that know, and I'm not calling myself an expert in forecasting what earnings are going to be. I simply look at what the experts are saying. I look at what all the analysts are saying about the companies, which are driven largely by what the companies tell the analysts they think they're going to do.
There's 5 factors in earnings. There are a group of earnings aggregators, FactSet being one of them, S&P Global, and Bloomberg. Those are the 3 largest. There are others. When I'm looking at earnings, I consider all of them, but really Bloomberg is my main source. I've used a Bloomberg terminal for the better part of my entire professional career. Probably started using it in the early 1990s when I was an analyst at Burns Fly. But FactSet for free. You have a link there I provided. They'll look at the 5 factors. They'll every day or weekly, they're going to aggregate up what earnings are, and they're going to tell you what's going on there. Are companies beating? Are they not beating? You can listen to the financial media. You're going to, okay, now slide 3. Okay, so you want me to go to here and start talking from this point. Okay. Thanks a lot, Wendy, for that. Okay, so market narrative. So the graphic here we're looking at on the bottom is the best earnings estimate that Bloomberg has. And how Bloomberg does it is they have all the analysts that cover all the companies put in their numbers into the terminal, and they roll them all up and they average them out, and they say this is the total number, and they do their index calculations and so forth. So for this year of 2021, $203.47 is the earnings of the S&P 500. Now, in dollar terms, it's a huge number, but you have to divide it by the index weighted calculation and so forth. So that's a big part of how they calculate that aggregate roll-up number. The narrative is important because the narrative drives the multiple, the narrative drives the risk part of things. But what I was commenting on here is that there's 2 graphics. Abby Joseph Cohen is with Goldman Sachs. She is widely thought of as an expert in earnings, as a strategist. Barron's Roundtable, incredible pedigree, and she's just a lovely person overall. But the experts don't know. Now, I'm not saying I'm an expert in earnings. I'm not. I don't go forecast these things. I'm looking at what the experts like Abby Joseph Cohen are saying and all the others from a top-down perspective, and then looking at the numbers from a bottom-up perspective and saying, are those in line? And then I come up with my number. And I'm saying, well, what should we pay for that? But in December, the first article here, December 2007, so the eve of the great financial crisis starting to unfold in 2008-9, Abby Joseph Cohen said the S&P 500 will be at 1675 at the end of the year, and earnings were going to be so much. She was only wrong by 50% that year. She had no clue what was coming, which is mind-boggling. So the street is notoriously bullish. They're always optimistic that things are going to grow, and rarely will you see people go outside of the more, So how do the top-down guys do this? Well, generally what we know is earnings tend to grow based on the rate of nominal GDP. So not earnings, revenues tend to grow based on nominal GDP. And of course, earnings are linked to revenues, right? The swing factor is the multiple. What are we willing to pay for that? And that really matters. So if the PE is 20 or 15 or 25 or 12, what do we pay for those earnings? So right now with the S&P ballpark at 4,400 and $200 in earnings this year, I'm rounding. This year we're trading at 22. Next year's number is roughly $220, depending on the sources you look at. But on the last graphic, 217 was the number. That means we're trading just over 20 times. And historically, that multiple should be around 16.5. So from a forward valuation perspective, we're getting expensive. So in my Pro-I series, there's 4 valuation factors we look at that make up this aggregate index. But my point here being that 2014, 15, and 16 saw no growth in earnings per share. 2016, Trump's elected. He makes regulation a little bit, so earnings started to grow. He cut taxes in 2018. Earnings started to grow. But they were growing, right, largely because of tax cuts more than anything else. This boost in earnings that we've seen, make no mistake, has been the colossal amount of money that was spent by governments all over the world. Massive debt increase. And that's kind of what's pushing the markets today. So I started first getting very, very cautious from a valuation standpoint, like 2015. And it just goes to show that just focusing on valuation is simply not enough. Earnings is one factor, and in my 20-factor Pro-I's model, there's 4 points. Okay? First point, forward PEs. So what is that number for next year? 12 months forward typically. 2020, where are we trading now? 4,400, we're trading at a 20 multiple. How does that rank relative to history? And so currently, we're in the 90th percentile. And what we know historically is that in the 90th percentile, on average for the next decade, markets tend to deliver probably 3, 4, 5%, returns, total returns annually. Could be 15% one year, could be 0 the next, could be down the next, could be down the next, could be up, but lower than average. So the markets are priced today where the average returns going forward are lower. And the way this works, as you can see with the down, is once we get a sell-off, the probability or the opportunity goes up. So you always really want to buy on dips. And the question is, how long do the dips last and so forth. And really, the world works based on that. Now, when we're in a cautionary area, which we are for forward PE, another way of looking at valuation is enterprise value to EBITDA. And what enterprise value is the amount of the capital stock. So you've got the equity that a company issues, and you've got the debt that a company issues against the earnings before interest, tax, depreciation, and amortization. How much capital do they have to work compared to how much money they're making before you deduct certain items. So enterprise value to EBITDA is a very good metric. And that's very, very extreme right now. So you've got several of the factors. Price to sales. How much are we paying for the sales that the S&P 500 is generating? Never been higher, actually. So we're at a point now where the market's really expensive. The one factor where the market isn't extreme today, still high but not extreme, is when we look at what's called the equity risk premium. And what the equity risk premium is effectively, well, let's adjust the current environment for interest rates. And if money's cheap and there is no alternative, maybe equities should be worth more. So the equity risk premium, when we're looking at it, is really, what is the financing rate? You could use the 10-year rate, you could use the 30-year rate, you could use an investment grade debt rate. You could use some factor of interest rates. In the model that I follow and I've built, I use the 30-year rate because, equities are long duration assets. 30-year bond is a long duration. And you look at, well, what is the market doing in relationship to interest rates? And in that world, earlier this year, it was much more expensive, but after the recent pullback and the rise in bond yields, a little bit better attraction. But the more bond yields go up, the more competition stocks have from interest rates. Now, if inflation is running at 5 or 6, assuming it's temporary or transitory is the word, but really, maybe it's 3 for the next few years, and the long bond is less than that, you've got negative real yields. So the equity risk premium is likely to stay low, which means stocks probably can maintain a higher multiple than the long-term average. If interest rates could normalize, then the multiple would have to come way down, a lot closer to that 15. Because there's so much debt in the world, I don't see interest rates normalizing. I've talked about that quite a bit. So if interest rates are going to stay low, the multiple is going to stay high. A lot of the traditional ways of valuing equities, in other words, the 3 things I've already talked about in the previous 3, may stay somewhat permanently in the top decile of history and present as very, very expensive relative to interest rates. So here's the thing. Interest rates and what the bond market does is going to be increasingly a major factor into what happens in the equity markets because of that multiplier, right, the PE. If the Fed starts pulling away and it's the Fed's buying of bonds and other central banks buying of the debt that is suppressing interest rates, we don't know that yet, but when they start to taper, if we start to see bond yields start to tick up, I think equity markets are going to have a problem. And so like in 2018, when the Fed was unwinding the balance sheet, not only were they not doing QE, but they were starting to reduce the size of the balance sheet. At the same time raising rates, stock market started to have a fit. Fed had to flip, start QE again. That is going to be part of decades to come, I believe. This is going to be a permanent part of the world and the markets. And we have to figure out, a little bit how to incorporate that, because the traditional ways of valuing things, you can't say throw them out the window, but when Abby Cohen and all the other ones talk about PEs, you can't go back and say, well, it's really high relative to history, because it's not as important today in the current narrative. It may be 2 years from now or 5 years from now again, but right now the market narrative is all about the cost of money. And so what the Fed does and how they do it is going to be very, very important, to the go forward. So when it comes to, the macro side of earnings, I've talked about the top down, the macro, the big number, the multiple. When we get to the micro side on the individual company, I'm going to give you an example of how I traded one of the stocks that we have in our universe. So JP Morgan, this is one of the Cadillacs of the finance business. Everybody knows Jamie Dimon. He's quite outspoken. Recently commented on Bitcoin that he thinks it's worth nothing, yet they make markets and they facilitate all kinds of things for clients and so forth. And he said, irrespective of what JP Morgan does for our clients, I think it's worth nothing. Anyways, so what I do is I leg in and leg out of positions. I like to know what the analysts think about the 1 year target. So generally an analyst will have a 12 to 18 month target for the stock. When you say what's consensus, it's generally 12 to 18 months out where these analysts are picking their number. I like, on average, it varies by industry. There's 11 industry groups. We looked at those. Some don't, the spreads don't get that wide to analyst expectations. It might be, 10%, 15%. Others swing wilder. There could be 30, 40% in growth stocks, deviation from analyst targets. But 20 is a pretty good number. So when a stock that I like fundamentally is expensive, I don't own it. When I say expensive, it's either expensive technically, meaning I don't like the chart, or fundamentally, it's already at its analyst price target. It may keep going higher. It could keep going higher. But to me, if you don't even have analysts saying it's going to be worth more a year from now, that's a big headwind. They could all be wrong. It happens all the time. But I'm just saying that's one of the key things for me. And when I'm fist pounding confident, I love the fundamental story. I love the valuation. I'm going to have as much as 3.33% in a stock, because the most concentrated portfolio that I'm going to run will have 30 stocks in it. And of all the economic sectors, 11 of them, and 125 or so industry groups, I'm going to try to pick the best names and the best groups. When I want maximum diversification, and the way you get maximum diversification isn't having 5 energy stocks or 5 gold stocks. It's having one driller, one, integrated oil and gas, one pipeline, but the one you think has the best risk reward. So in my universe of stocks, and we run a stock portfolio, it's not in the BMO world. We run a stock portfolio. Right now we have 826 names in our fundamentally screened universe. JP Morgan's one of them. It's basically the Russell 1000, the top 1,000 stocks in the U.S., with half the stocks filtered for bad fundamentals. So I get rid of the bad balance sheets. I get rid of the companies that don't have good earnings prospects or a good return on investment. I just get rid of them. And so now I have the top half. And that becomes my universe. And then I said, okay, out of that universe, let me throw in the Canadian names. Let me throw in the international names by way of ADRs and emerging market names by way of ADRs. And that becomes my universe. And so I filtered, knowing that overall, these are pretty good companies. They've got pretty good track records. They got pretty good earnings histories and so forth. Now I trade them. And so I will leg in and leg out. So a few days ago, knowing that JP Morgan was going to report this week, we hit the price target. I actually top picked the stock. You almost never do this. I sold it out above 171. If you can see the blue line there, 171 was the price target, analyst price target, 12 to 18 months down the road. I bought the stock into the portfolio, but I only bought a small position right? So when I want maximum diversification because I'm worried, my pro-eyes indicators are telling me that there's market risk and it's higher than average, I don't want a concentrated portfolio. I want more diversification. I want 100 names. I want the best 100 out of 125 different industry groups. I want one or two, and maybe in each one, of the best risk returns at the time, roughly 1% each. And if I really like one, it might be 1.5, maybe 2. But that means some are going to be 0.5%. And I leg in. And as the risk rewards improve and decrease, I trade them around. It's a very, very different approach than a Warren Buffett, right? So should you trade earnings, and do you want to? I'm showing you what I do here in our stock portfolios for clients. If you want to find out more about that, give us a call and we can help you with that. But so JP Morgan reports yesterday, they beat the numbers, stock sells off. Why does the stock sell off? It was all priced in. All the good news was priced into the recent run-up. So I last bought the stock. If you look at that histogram at the bottom, the last time the stock was 15, 20% below the analyst target was in June, July. And that's when I was accumulating. I was adding JP Morgan. The chart didn't look good at the time. I don't care. I'm a value guy. I want a good price target and a name that I like. So as the yield curve was flattening, as bond yields were coming down, the bank stocks were selling off. And I'm thinking, no, we're going to reopen. We're okay for a while. We're not going into recession. That yield curve's not going to invert. Bank earnings are going to keep growing. So as the chart starts to look terrible, to me, there's value there. So I put a 0.5% into JP Morgan. And Larry, you might say, well, why didn't you do 1.5 or 2? Well, because it got to the 20% number literally for less than an hour. So I run an algorithm and it says if you're at this price or lower, just buy. And I'll buy up to 1%. I got 0.5% in. And then it went the other way. And so that's all I bought. But then I bought 5 or 6 other bank stocks that also had good risk reward relative to the forward price targets. And I added those to the portfolios. And those are all up 10, 15. I got one bank stock that's up close to 20% from where I bought it in the summer. And so I trimmed JP Morgan. And after earnings, stock comes crashing down. It's now 10% below the 1-year price target. I ran an algo and I bought that 0.5% position back. Now, if over the next couple weeks or months, it goes to 20% below the analyst target, either because the target's going up or the price is falling or some combination thereof, I'll add to it. But if it turns now and goes back to that target, which looks to be about 172 or 173 because of some recent upgrades, I'm out again because the risk return no longer there. So that's kind of how I do it around earnings. And so the question is, are you guys equipped to do that, and can you, or do you want to? There's a lot of free information out there that you can use. I provided some links for you guys tonight so you can kind of drill down and do that. And so hopefully you get a sense of how I look at things. We've got about 20 minutes for questions now. So let me go into the prepared questions, and then I'll go to the online stuff. And so I guess we lost about 10 minutes tonight with the audio problems. So sorry for that. So Ron is asking, with a stock market that's ridden the liquidity wave of the last 16 months, when the Fed actually begins to remove it in November, will that same stock market act like a balloon with a major leak? Ron, that is the perfect question why I put this as the first one tonight, because that's kind of what I'm talking about. From the macro earnings perspective, I don't know the answer to that. My suspicion, Ron, is that if bond yields push up because we got new supply coming in, they pass a bill without the GOP, they get this infrastructure, they got to finance $1.5 trillion of new debt next year. And if the Fed isn't buying it, Who's going to buy it? Well, at this yield, it's got to go higher. So if the U.S. 10-year stresses out towards 2%, that multiple that's 20 times next year's earnings, based on an equity risk premium formula, probably goes down to around 18. So an 18 multiple on two, assuming we're going to still get 220 in earnings, because fundamentally the economy hasn't changed. So an 18 multiple on that, and you're at 4,400. So no growth at all for equities next year if bond yields go up and stay there and the market starts to believe the multiple should be lower. Great question, Ron, and it's something that I think about. I will certainly talk about it if I see that at the next Fed meeting, November 3rd, if they start to taper, meaning that first month they'll buy 20 billion or 15 billion less in bonds. How aggressive are they? Do they start talking about rate hikes? Who's the next? By that meeting, I expect that Biden will have nominated who he expects the next head of the Fed to be. Is that going to be more dovish? Are they going to continue to do QE to monetize the debt? Biden doesn't want to lose the midterm elections in the Congress. And in order to do that, the economy's got to be very strong and the stock market's got to be very strong next year, or they're going to flip it. So they're going to do everything they can to promote a strong economy and a market next year. And if that involves rigging the Fed to put a lot more doves in there so that they don't back off of QE, we'll see. But if inflation upticks and the Fed will have no choice but to start to pull back that accommodation, that's a scenario where you could get more of a dip in equities. And that is certainly on the horizon for next year at some point. So, recently, my parents retired and asked me to help them to invest. Unfortunately, they could not save enough for a comfortable retirement, but they live very minimal lifestyles and have few expenses. They're looking to invest in modest savings that pays them from income and dividends and yet keeps the principal relatively safe. This would be a great question for next week. And Hassan, please tune in when I have my conversation next week with Monique Madden, who's head of life strategies at U Potential. She handles the vast majority of the financial planning that's part of dealing with my firm, ETF Capital Management. I don't get involved in that at all. I have experts that do that stuff because really it's about your goal, right? So how much do your parents need to live off? I can't give you a recommendation of what to invest in because I don't know their tolerance for risk. I don't know anything about your parents. And that is how you should invest for them. That is the essence of next week's conversation. Your portfolio should have a lot of core in it, like Erica talked about tonight. And the focus should be, what is the goal of that? Not necessarily maximum return. What does that person need? And that can drive how you invest for them. Some people don't want to draw down their principal. Some people don't care if there's anything left. Some people want to leave it to charity. There's so many factors involved before you put $1 to work. Putting $1 to work is as easy as Erica showed with those, automatically globally diversified, balanced portfolios, the growth, the conservative, the 20 basis points, folks. It's rebalanced for you. It's core exposure to the entire world. You'll generally do just fine, and you'll get what the vast majority that Erica said, the managers can't beat the markets anyways for 20 basis points, right? The problem with that, of course, is that the bond side yields aren't going to give you what they've done in the past. And that, Hassan, is the biggest problem for retirees. It's a massive problem. And we'll talk more about that as the weeks go on. In what I like to term the death of the 60-40 portfolio. Paul is asking, he'd like to use ETFs to gain exposure to different sectors and themes. However, finding that the composition are very significantly different. Unless you're Kathy Wood, you don't know much about the manager. So ZPay is an ETF that I talk about that yield one with the option strategy. I'm actually, we haven't nailed the date down yet, around mid-November, I'm going to have the portfolio manager who runs the ZPay ETF on for the entire presentation, and we're going to talk about generating yield, how they run ZPay, and how they do the covered calls, and how they write the puts, and the whole goal of that yield-based investing. I think it's going to be a fantastic hour-and-a-half presentation. And so the vast majority of ETFs are linked to an index, Paul, and it's not the manager who's active. Now, some of them are active, like a Kathy Wood, but you don't know at any point in time what that active manager is going to have. So when Erica tonight talked about core, you know the S&P 500 is the S&P 500. You know you're going to get that return at a very, very, very fair price, MER-wise. Now, when there's an active manager, you got to pay more for it because they're working, they're doing active decisions. If it's just linked to a passive index, the S&P 500 is the cheapest, the big indexes, because there's lots of ways to hedge them and do them, and lots of vehicles and money in them. So the liquidity and trading is very easy, so they're very efficient and cheap. The more complex an index is, the smaller cap stocks, harder to trade, international, where they've got to buy stocks in Japan, but at the same time in the U.S., while if they're both closed, they can't do them together. They're harder to operate. They're harder to create new units. They cost more, right? So great question, Paul. And there's a lot of nuances to it and to how that works. But I'm going to have that one, and I think there's going to be one other one we're going to do, and I've yet to determine that, so I don't want to talk about it, but I'm planning at least to have 2 portfolio managers who run active styles as guests. Sean is asking, with the record debt and mountains of cash sitting on the sideline, what are the large institution and asset managers waiting for? Well, Sean, the large institutions and asset managers aren't sitting on cash, I can promise you that. They are fully invested because their mandates say they have to be fully invested. BlackRock is not sitting on $1 trillion in cash unless clients, or you guys, are taking your money out of a fund and putting it in a money market fund. A big pension fund might run a little bit of cash, but cash is trash. It's not going to meet their number. They'll use it for liquidity needs, but otherwise they're going to be invested in something. So the elephant in the room is essentially that individuals will have cash, hedge funds will use leverage and they'll have cash, and so an active component of the market. But the vast majority of people are fully invested. Okay, so this whole notion that there's piles of cash on the sideline, listen, a lot of individual investors have pulled money out. They've gone into private credit markets. They've gone into other places. Cash doesn't pay much, but if you're terrified of the stock market, this is why you've got to learn how to use other things. You've got to be able to rotate. If JP Morgan doesn't look good, you got to sell it and buy something else that looks better. Risk return. Now, if you're in a taxable account and that's generating a lot of tax for you, then that's a whole different thing. Okay, so something to keep in mind. Dusty says, I love your show and I miss seeing you in person. You know, I was at the Leaf game last night, and it was my first real live event other than dealing maybe with people in our office and my immediate circle of friends. And you know, it was just great to get out and shake someone's hand knowing they were vaccinated. And, you know, it was great. So I miss seeing a lot of folks in person. The question is on green technology. I know nothing about this company. I saw the question. I looked into it. There's nothing I can tell you about it. So, but, you know, the greening of the world, the cleaning of the water. This is going to be an investment theme for decades. And there's ETFs that play the broader spaces. You can dig into these small and micro cap companies. Don't ever ask a guy like me, because I don't do that work. I'm not going to give you any value added on a tiny, teeny company that no analysts follow, and I can't possibly generate an opinion on it without going through reams of financial data, days and days and days worth of work. And I don't have the time and bandwidth to do something like that. So thanks for the question, Dusty, but I'm not going to be able to add any value there. Nick is saying, can I comment on the impact of inflation from the perspective of the Canadian dollar? So I've heard that inflation tends to depress the Canadian dollar. So that has to do with relative interest rates, generally speaking, between Canada and the U.S. If the Canadian inflation rate is higher and the Bank of Canada is more aggressively tightening rates, Canadian dollar would get stronger. If the U.S. rate is higher and they're tightening more than Canada and the U.S. dollar is getting stronger, that would be a factor that moves the markets and currencies. Right now, the biggest factor seems to be that the Bank of Canada and the Canadian economy, we're back to where employment was pre-COVID. There's narrative around the Bank of Canada getting to unwind the QE faster than the Fed, so they would be tightening quicker. They'd actually start raising interest rates and so forth. And so the Canadian dollar, with strong energy markets, biased to get a bit stronger, and why I've moved more towards hedging exposure recently in the Canadian dollar versus the U.S. dollar in the portfolios. I have some U.S. dollar exposure at the moment, Nick. Okay. Roland's asking about Bitcoin, the last written question here. I said, if you can afford to speculate, go for it. I didn't recommend you to go do that. So please don't put it on me. And you lost about 30%. And now it's back. Bitcoin is going to be the most volatile asset probably you will ever trade. When that stabilizes, I have no idea, and I don't expect any time soon. I think it's worth, like Jamie Dimon, I think it's worth close to zero intrinsically. I look at it as a hedge. I look at it as a piece of art. Beauty is in the eye of the beholder. But if you ask me how to put a value on it, it doesn't have any cash flow. You can't factor it properly. It is an economic experiment with a limited amount of supply and demand. And as long as that demand curve keeps growing, relative to supply, price is probably going to go up. But as soon as that demand curve goes down, supply is constant, price falls. That I can tell you for sure. As to the shills that are pushing it as being good for ESG, I think there are a bunch of promoters that have vested interest in this space. I wouldn't know who to trust. The God's honest truth to who to believe. And so without having vetted that you can produce Bitcoin better than you can produce gold. But I can tell you one thing. I don't have my video on anymore. You can't wear Bitcoin here. You can't use it in electronic development, or you can't use it, right? And so Bitcoin is to me, it's the biggest bubble we may ever see in our lifetimes next to tulips. And that's my view, and I'm sticking to it, and maybe I'll guy. Anyways. Okay. Looks like gold is on a move up. Any comments? Listen, gold's been very disappointing. It's been one of the more challenging things. Gold stocks right now are amongst the cheapest assets fundamentally, and maybe because of Bitcoin and cryptos, it stays that way. Gold should be way higher than it is, and it's not. And usually when something should be higher and it's not, something's changed. So, I've been reducing my exposure on rallies. I still like it as an asset class because it's uncorrelated with most things. So you can think of Bitcoin in different ways. You can use it that way if you like. I'm never going to recommend you do that again because of the value proposition. Okay. I keep the spec portion of my portfolio to around 5%, 1% per trade, usually at the money calls and puts. Okay. All right. Let me see some other questions that have come in here. Do I feel oil and energy stocks seasonally peak in mid-October, as do some of the master prognosticators? So there are seasonal patterns in every market. And basically, you look at what's happened over the last 20, 30, 40 years of asset prices that you can, and then you kind of smooth it out annually and you see these seasonal patterns. So equity clock is a good way to look at that. I think I featured that maybe a year or two ago in one of the webinars we did. So seasonal patterns are a factor. In my Pro-I series, there are two factors: the current presidential cycle. Again, I'm doing the S&P 500, and then all 4 cycle years of the U.S. market. Individual asset classes. Seasonal patterns are a bias, and they're one factor. If stocks are cheap and the seasonals are positive, you got more confidence in buying. If the stocks are expensive and the seasonals start to turn negative, I think you want to be underweight. So that's a great question, Michael, and hopefully that gives you some insight into my thoughts there. As to what happens this time around, do we get a supply response from OPEC+? If we get a big enough supply response, there's plenty of excess capacity in OPEC+. They could push oil prices back down to the 60s. Do they want to do that? Probably not. Where is the world comfortable from a non-inflationary impact standpoint, where OPEC's making money, Texas is making money, Calgary is happy? It's probably $60 plus. So as long as oil holds above $60, most of these stocks will find bases and support levels on pullbacks. How high do they go? Are some of the guys saying 100? Yeah, maybe. I don't know. But I would, at this point, the closer you get to 100, be looking to sell into that. When people get more fully invested in the energy story, that's the time you want to start pulling back. So I'm still overweight energy, but I'm looking to trim it a little bit. Lost capital in past years investing in the bulk carrier SBLK, recently recovering capital, rolling call options on the stock. Can I give us my outlook? So this is really, it's the global shipping area. And so, John, so thanks for that question. Global shipping, I think globalization is still a big thing, and it's not going away, but we may have seen peak globalization, and onshoring, more domestic manufacturing, I think is going to be part of the next cycle. So I wouldn't look for global shipping to break out in a big way here. More questions online. Let's see how we're doing for time. We got a few more questions. Okay. I just recently added some December call options on Goldman Sachs and Alcoa to the more speculative portion of my portfolio trading account. Just wondering my thoughts on the two equities into the Christmas timeframe. So again, what does the Fed do? So a big part of, to me, is the macro. It's always a huge part of how I look at things. And so if the Fed comes off as more dovish, then we should be able to rally a bit into year end, maybe a retest to the old highs around 45, 50, 4,600 ish. What do some of the big name stocks do? You know, they would look to retest their highs, maybe 5% higher, somewhat in line with markets, somewhat higher than that. That's kind of how you would estimate where most stocks would go that have a beta that are similar to markets that are leveraged kind of off market market movements. And I have time for one more question here. Let's see. I thought you preferred ETFs to stocks. I'm surprised to learn that you buy stocks instead of ETFs for your private clients. Well, Jean-Pierre, thank you for that question. You know, I started off as a stock guy. And when ETFs first started 30 years ago, I started trading them right away. So kind of like Erica talked about, Core and Explore. So we have a global growth portfolio, ETFs. The 3 funds I run for BMO, ETFs. Part of Q Wealth platform, we run a fund, and that fund is single securities. And so we will own a core part of the S&P 500, and when we find stocks we like, we'll buy those stocks. And when there's no stocks we like, we'll kind of own markets. So I run a lot of different mandates. There's nothing at all wrong with owning individual stocks. I never said there was. I named my firm ETF Capital Management when we started almost 15 years ago. In fact, October 31st, coming up very soon. November 1st will be the 15th anniversary of ETF Capital Management. And then very soon after that, the 15th anniversary of Berman's Call that was born just after ETF Capital Management was born. So I'm surprised. Talked about stocks for years. People call in and ask, but I love ETFs. Don't get me wrong. But often, not always, but often, stocks can make a difference. But I explained how I look at stocks. I don't look at stocks like Warren Buffett looks at stocks. I have a trader's hat on. I'm tactical. I'm active. So I look at risk rewards. And so whether I'm looking at the risk reward of an individual stock, or I'm looking at the risk reward of the all financials ETF, all banks ETFs, it's a very different style. And I'm equipped to do both. So thank you for that question. Anyways, folks, we're out of time here. Thanks so much for joining us tonight. And please, if you're enjoying and you're learning from us, give one of our sponsors a shout. Let them know that you're interested. And please, please, please make a donation as we get into the holiday season here. Help kids with cancer at Sick Kids Hospital, or the folks that are stricken with dementia, Alzheimer's, and Baycrest Foundation does some of the best research in the world to help eliminate this terrible thing that impacts people. Have a great week, everybody. See you next Thursday.